Thank you for joining me today. My name is Michael Lee, and I'm one of the wealth advisors here at Farther. I want to thank you all for joining us as we go into our talk today on Kaiser Permanente's pension plan. Now, as we begin our discussion, I want to make sure everyone understands that although the information we cover today will be specific to KP, myself and my team are not a part of the company. We're a separate organization that does retirement planning specifically for KP folks, but we're not in any way endorsed, affiliated, or part of the company. Our services are provided through Fidelity and Charles Schwab. We help manage retirement assets that come from the pension, the 401k. But again, we're not part of Kaiser. Now, what sets us apart from most other financial advisors is when we provide help on the planning and retirement and all your benefits. It should feel like you're talking to someone internal with your company. That's because as fiduciaries, we try to have a comprehensive understanding of everything that goes into your company plans so that we can provide you advice that can be seen in your best interest. Unlike most advisors, we specifically specialize with KP. So we should understand how your pension works, how your 401k or your TSA or your Plan B, all those components that make up your benefits package are things that we will be familiar with. We give advice and guidance on all aspects of your financial life. So this can be your company benefits, this can be your investments, this could be tax planning, estate planning, just any type of money question, we would be your guy. Now, to dive into the meat of today's presentation, we're going to talk about the pension plan. And the pension plan at Kaiser, there are nuances depending on your business unit. What we've done today is picked out two to serve as our examples, but we're very familiar with all the different plans offered through KP in all the different regions, all the different job titles you could possibly have. These are just the two that we picked out today. On a one-on-one basis, we would be happy to go over your plan's specifics, but they do differ even amongst or within Kaiser. So one we've picked out today is TPMG. We're going to talk about the Permanente Medical Group pension plans. We're also going to touch on what we call program office plans. These two are very similar, so we'll use these as the first example. But again, if you have a different one and you want us to talk through it with you, we'd be happy to do that. For both of these plans, the retirement age, or what we call early retirement, begins at the age of 55. And generally, you should have at least 15 years of service, or you add these up and you should have at least 75 points to qualify. Qualifying is not the same as vesting. So if you see anywhere on your documents, whether you're vested or not, that is simply talking about whether you have that 5-year minimum to get some kind of payout. But what I'm listing here with the 55 and 15 or the 75 points, that is what you need to qualify for early retirement and basically have a claim to the actual money. Whereas a vested pension means you'll get something later. A lot of times you have to wait. And I mean, wait all the way until you're 65, which is the normal retirement age at KP. Even when you hit early retirement, you'll notice on the right-hand side what we list as age penalties. So early retirement is great, but Kaiser and almost all companies that offer pension these days, they don't do this out of the goodness of their hearts. These are meant to be retention devices. Pensions are designed to keep you at the company while you're most experienced, most valuable. So the way they do that is by attaching age penalties to it to discourage early retirement and that you have something to work towards to give you a reason to stay until you're 65. The chart on the right looks like it has a bunch of random numbers. So I'll give you the formula. For each year you're under the age of 65, there's a 3% reduction for the first 60 to 65 range. Every additional year you're under the age of 60, there's a age reduction of 5% that is stacked on top of the original. So it's either 3 or 5% haircut per year you're under the normal retirement age, which again is 65. 65 is usually what most people at Kaiser will begin the retirement planning targeting, because a lot of times for most business units, this also lines up with your retiree medical plan, Kaiser Senior Advantage that you get from the company. But generally, you can retire earlier and still count on your pension. You just need to account for these penalties that would be assigned. Now, let's dive into the formula here on what these reductions would be applied to. So the first example we'll go through is the TPMG plan. And the bubbles on the left-hand side represent how they calculate what you would get as a monthly pension. The first bubble here, and we've abbreviated some of it, so I'll explain each component. The highest average compensation. So what they mean by this is like your salary, your paycheck. That's the first component that I look at to see how much they should give you as a pension. They give you the highest five of the last 10 years of work. So what this means is if you get a promotion towards the very end of your career, let's say, you know what, Mike, I wanted to retire next year, but unfortunately, I had, or fortunately, let's call it fortunately, I got promoted and I got a big pay raise. How will that affect my retirement? Well, initially it doesn't. You need to actually stay at least 5 years in that new role to get it to factor into your pension. The opposite would also be true. Imagine you're in a situation where you have a switch to part-time work. Maybe you reduce your hours, maybe you want to ease into retirement. That won't affect your pension as long as you don't do that new position for more than, or that new hourly arrangement, whatever you want to call it. As long as that doesn't extend over 5 years, you won't start walking backwards on your pension. So these are some nuances in the formula that we generally advise on. The middle bubble is the 1.5%. So this can differ depending on business units, but it's usually around 1.5, can get down to about 1.4, depends on the position. It's a static number that is designed to just be your factor against your pay. So to make this really easy, I want you to imagine you work here for 30 years. That's the next bubble, 30 years of service. All you do is take 30 times 1.5. That equals 45%. And you would get a pension, a monthly pension equal to 45% of your pay. This is called the pension formula. This is what Kaiser has for TPMG, is the old school defined benefit pension. So it's just this formula. And this monthly pension is what you would receive per year for the entirety of your retirement. From this monthly pension, we will compute all the other payout options. So Kaiser doesn't just do the monthly. They have a lump sum choice. They have all these other payout options that all stems from this. So this is the foundation of how the calculation is done. Pension offsets, so the last bubble on the right-hand side, this will refer to something like the age penalty that we talked about earlier. This could also refer to subtractions if you have multiple pensions. So for a lot of people, if you spent your entire career at KP, you may have switched from program offices to TPMG or the other way around. Maybe you started as a union employee, moved your way up into management. Those are all great. And you will actually have different pensions per stint of time. They get offset against each other though, meaning you don't get to double dip for the time. You usually get, 10 years of union time, 10 years of TPMG time, 10 years of program office time, even if your total career time is 30 years. So that's what we mean by pension offsets. Now, the KFHP, the KFH pension is actually exactly the same formula-wise as the TPMG pension. But again, don't be misled here. This can differ for different business units. So I'll throw out a few examples. Some of the union positions don't get 1.5%. Specifically, as another example, CNA, they don't think of years of service as simple as did you work here for 1 calendar year. They actually have hourly requirements to make sure that, you have to clock enough hours over the course of a year to actually have it count as a year. There are small nuances between all the different plans, depending on what your position is in Kaiser. And these are things that we help you figure out to make sure you're getting credit that you deserve for all of the different pieces. Now, so I skipped ahead a little bit. This is where we explain the pension offsets and the age penalties. Again, the main thing is normal retirement age is 65. If you have several pensions, you do not get to double dip for that time. That's the offsets, reducing them down. Now, this is usually everyone's favorite part where we talk about the payout options. So I want you to imagine you work at Kaiser for 30 years, you get to the end, they say, thank you for your service. How would you like your pension money? Here is listed as all the payout choices for TPMG and program offices. Each payment option has its own rules and consequences, but what we've laid them out as is the very top row here are probably the ones we see most often and most popular. The middle choices are the ones that are unusual. So Kaiser does a lot of choices, and these are the ones that are not always found everywhere else. So they take a little bit more explaining. They're not traditional payment choices. And then the bottom row is the installment payments, which is actually just a TPMG only payout. I'll explain each one of these. Single life annuity would be the traditional monthly payment that someone who is single, widowed, or divorced would get. It is the number from the formulas on the previous screen. So it's just per month, you get 2 grand a month, 3 grand a month, whatever your number is. That will be paid for as long as you live. On the beginning of every month, you get that number deposited into your checking account. There are several factors here that you'll need to understand. This is taxable as income, meaning when you get it, whatever number the pension estimator shows on my KPHR, that number is the gross number before taxes. You have to subtract out what federal taxes would be and what else the state tax if you live in a state that has state income tax. This number is not inflation adjusted. So whatever check you get on your first month of retirement, it will be the same check you get on your last month of retirement. Even if that retirement is 30 or 40 years long, there's no inflation adjustment. This is the opposite of Social Security. Social Security should go up a little bit every year. The pension does not. It is a static number. Last but not least is the safety of this money. So Kaiser is required to get PBGC insurance, which means that even if Kaiser's not around in the future, whether they've gone out of business or had financial troubles, they have pension insurance, so to speak, that would make the government would make these payments on behalf of Kaiser. Now, the second bubble here is very similar to the first, but designed for married couples. So especially if you're in a community property state, this is more seen as your default choice, where there's 2 lifetimes instead of one. The percentages refer to what your spouse would get or what the survivor gets after one person passes. So on the joint and survivor annuity, you get, let's call it 3 grand a month. When your spouse passes away, or when you pass away, and this is unique at Kaiser, they do it where, regardless of which person passes, the remaining person gets 50%, 66%, 66.6%, or 75% of what you used to get as a couple. So while both people are alive, you get the bigger number. When one person passes, you have a smaller number. When both of you are gone, it stops completely. Now, unique to Kaiser is this kind of non-preferential treatment. A lot of other companies, when they do a join a survivor, there's kind of like a bias or a leaning towards the employee where, if you worked at Kaiser but your spouse predeceases you, you're not hurt. Like there's no reduction for you. That is not true at Kaiser. They don't care who is the one that passes first. They will reduce it down once one person is no longer around. So this is a very important point because it makes it a very team decision. You need to not just look at your health, your life expectancy, but your spouse's health, their life expectancy is equally important. Now, the third most common option we see people take is the lump sum payout. This is where you say to Kaiser, I don't want a monthly payment. I'd rather have all my money up front. And they say, okay, instead of sending you $2,000 a month for the rest of your life, we'll give you a one-time payment for 400,000. This number can vary every year. It can go up or down because this is a calculation against your life expectancy of what your pension would have been. So there are key variables to know. Just know that when you look at your pension estimator, it's not a mistake that the lump sum is going up and down, even if you continue to work longer. You will never notice an up or down motion with the annuity options because every additional year you work, it will climb, but the lump sum can start to decrease over time. So which payment option you're leaning towards should have a bearing on when you want to retire. And there are situations where you can continue to work and really be reducing your pension. Now, the um, other caveat is the lump sum is paid to you all at once. It is just like the other payment options, taxable as income. So one of the big mistakes you should avoid is getting that lump sum paid to you directly. Best practice is you pay it to your IRA. This is the same IRA your 401k or your TSA would go to. And this is what we call a rollover. By doing a rollover, which is a retirement account to retirement account move, this would continue to defer the taxes, and you would only pay taxes when you start to take it out from the IRA, and only on the amount that you take out, you have control over that. The lump sum has these additional rules and additional things you need to do, and it is more complicated than the other two, which are just direct deposits that show up every month. But in exchange for that, you get the flexibility of controlling how much you use per month, how much you pay in taxes per month, and then anything you don't use can be left to your children, your grandchildren, your spouse, your siblings, your church. You get to choice on who your beneficiary will be. With the monthly payouts, once you're no longer around, if there was a remainder, Kaiser would be the one keeping it. Now I'll go through the second row here. These are, I'm going to say, less popular, but still viable choices. Most people pick one pension option, and it's going to be one thing that they can never change. It's an irrevocable one-time life choice. Which one fits your family best will depend on your situation. We don't think there's a right or wrong choice, but there's definitely, you know, some that are more chosen than others. Fixed period and life annuity is very similar to the earlier annuity payouts that we went over, where it's a per month for your lifetime, but there's an additional reduction. You are giving Kaiser back some of the money in exchange for a 5, 10, or 15, or even a 20-year guarantee. So how this guarantee works is if you claim this option, let's say you pick the 20, and you live 17 years into retirement. You're not married, you're just single, but you pick the 20-year fixed period in life annuity. After 17 years, you pass away. Kaiser will make 3 more years of payments. So the remaining time to whoever you want, wherever you want. You're guaranteeing a minimum of 20 years of payments. Now, if you live to be 21, 22 years into retirement, when you pass away, it will stop completely. So it's a guaranteed minimum number of payments. If you live longer than that, it continues indefinitely as long as you're alive. This only happens if you pass before the guaranteed time frame. This is not free though, so it's not like why doesn't everyone choose this? Or why doesn't everyone pick the longest time? They will reduce what you get per month to give you a longer and longer guarantee. So the guarantee for 5 years, it'll be barely noticeable. The guarantee for 20 years, it'll be a lot bigger chunk that they take off your number. Now, the second bubble on the second row is 100% joint and last survivor annuity. And on the printouts on my KPHR, it also has with pop-up and all these other features. This is kind of like the catch-all, every feature put together into here, but it has the greatest reduction. How this one works is you get a per month number. If your spouse predeceases you, it'll actually go back up to the single life annuity. If you predecease your spouse, they get 100% of what you used to get. And in addition to that, there's a 15-year guarantee on this payout. It pretty much has everything we talked about prior, all wrapped in one, all the extra features, guarantees, bells and whistles put together in one package. But because it has all those features, you'll notice that compared to the other monthly payouts, this will be the lowest one. This is the one that I would typically see people that are on their first and only marriage lean towards because it offers the greatest protection on the spouse. A lot of times with, mixed families, second marriages, third marriages, I see the pension as assets that are either decided on separately, held apart, or you do what you want to do with yours, I'll do what I want to do with mine. There's that kind of shift there depending on your family dynamic. Again, you can only pick one, so you have to carefully evaluate which one would be the best fit for you, your spouse, and anyone else involved. Now, the third bubble on the second row is the level income annuity. This is probably the least popular. Um, Over my last 12 years of working with KP, I've never seen a single person take this. Level income is what they are referring to as a level experience throughout retirement, where you experience a higher pension before your Social Security age. So you have to be retiring before Social Security age. Once you hit Social Security age, they reduce your pension because they expect you to claim Social Security, and the reduction is equal to what you would get from Social Security. So it gives you this feeling that you get this set number, even if you retire pre-Social Security age, but with the future reduction. It's almost kind of silly that you would make your pension change hinging on what happens with or without Social Security. I've never seen a person pick this, but it is an option that is available on your choices. The fixed period and life annuity plus level income annuity is just the two bubbles previous of this combined, where they'll guarantee a number of years as well as give you that level experience. This is, any level of income annuity, I'm going to say are the ones that most people kind of shy away from, and these are probably the least too popular. Now, on the last choice, this is the installment payments. This is for TPMG only. So how this one works is you say, I don't want a lifetime component. It's similar to a lump sum, but instead of getting the money all at once up front, they give it to you in installments. You can pick the installment times, but they pay it out to you over time. Generally, pretty unpopular because if you wanted installments or you wanted your money up front and you picked like a short time frame, you might as well have taken the lump sum and be eligible for rolling it over. If you wanted a long time frame, it's almost like why didn't you include the lifetime piece? The installment payments has no lifetime component, so it's just a set number of years, and it's not that different from taking the single life annuity over that X amount of time. Or the fixed period and life annuity with a guaranteed number of years. So this one again is TPMG only, but I haven't I've rarely seen this one used. You get the choice. So about 3 months before you retire, you'll get a big packet from the pension people, and you get to pick one of these 8 different choices. It's a one-time irrevocable life choice. So a lot of the retirement planning, understanding your pension options goes into saying just which one you want to pick, which one fits your family situation the best. Now, of all of these, the one that has the most nuances is probably the lump sum. So a lump sum calculation actually has two additional variables that stem from the fact that when you look at the lump sum, if you check it this month, if you check it next month, you'll notice that the number changes on a monthly basis. That's because the lump sum gets calculated on the spot by the calculator, and there are two variables that change all the time. One is your age, one is your segment rate, which is like the interest rate for the calculation. If you take the monthly payout, so this is the annuity payment, neither of these will affect your calculation. But if you want the lump sum, what they're doing is they're converting your monthly payment into a one-time payment, and each of these variables will be involved. So to explain the age component, I'll just give you an easy example. Imagine you work at Kaiser, I work at Kaiser. We have the same job, we do the same thing. We've both been there the same amount of time. We have 30 years of service. We're considering retiring. You're 66, I'm 56. If everything else was held static and equal, and we both claimed our pensions would be the same if we took the monthly because we both worked there 30 years. We have the same job title, same pay. We both get, let's call it 3 grand a month. When they convert the $3,000 a month into a lump sum, one person is 10 years younger. So they should get that per month number for 10 extra years compared to their colleague. What this ends up meaning is that the person with the longer life expectancy will get a bigger lump sum because there's just more payments in their calculation for the extra time. So the younger you are, the bigger your lump sum will be. I know it seems counterintuitive, but again, the younger you are, even if everything else being equal in your career, the bigger your lump sum will be. The second piece, and this is even a bigger factor, is the segment rate. So we have to look at this one from Kaiser's point of view. So imagine Kaiser says, we owe you $2,000 a month for the rest of your life. And you say, I don't want $2,000 a month for the rest of my life. Give me my money today. They have to give you what's called an actuarial equivalent. So based on your life expectancy, based on the current prevailing interest rates, how much money do they have to give you so that you could invest it, grow it, keep it, so that it would generate the equivalent of 2 grand a month. If interest rates are really high, that means they need to give you more to start with to generate the same per month number. Sorry, if interest rates are really high, they don't have to give you as much to start with for you to generate that same 2 grand a month. But if interest rates were to suddenly go down, they have to give you more and more money for you to invest, get interest on it to recreate that same 2 grand a month. So from a timings perspective, Kaiser retirees that want the lump sum need to keep two things in mind, their age and the interest rate at the time that they retire. Because there are certainly months where you can retire where the rate or your age as you climb could hurt you. Sometimes it makes sense to retire earlier. Sometimes it makes sense to postpone your retirement date. Timing is a factor, especially if you're going to look at the lump sum. If you're looking at one of the monthly payouts, timing is not as important. But again, these are considerations you need to make as you plan your retirement. And the pensions are things that you have control over. As long as you know how the calculations are done, as long as you know how the payment options are calculated, there are better and worse times that you can do this. And this is a active decision you're making. You should not base your retirement simply on, when your house is paid off, when you hit a certain birthday, or when your kids graduate. It should be based on how you can get the most out of your benefits. Now, if this was helpful today, I'll walk you through some of our next steps. So at the Focus team at Farther, we specifically do retirement planning for specific companies, KP being one of them. You're on the very first step of our process where we help educate you, understand your benefits, your plans, and just how to get the most out of your package. If you like what you heard about today and you want to take the next step, where we actually help you construct a plan, do one-on-one planning, that is something else we also offer at no cost. We'll help you look at your expenses, your savings, your different company benefits, Social Security, Medicare, Kaiser Senior Advantage. All of these things are components that we'll include in a write-up that we do for you. And on one-on-one call, we'll talk you through exactly what you need to do to be able to execute a retirement successfully. If everything we talked about there sounds good, but you're not sure about how to do it all, that's where we come in and we actually help you manage the accounts. This is where we will hold your hand through each step of the process, help you pick your investments, monitor it, make adjustments as needed, do the tax planning, the estate planning, everything else involved. That is the part where we do have to charge for our services. But everything before that, so the educational stuff, the plan we put together, those are complimentary for anyone who's looking for help. So if you're interested, feel free to contact us here. This is a service we provide for KP employees. Again, we're not affiliated with KP. We just specialize in working with your company. We're very familiar with your company plans, but we're not in any way endorsed, affiliated, or associated with the company. But you are our specialty, and if you'd like some help, we'd love to be there for you.